Bandhan Mutual Fund presents MF Corner.
Hello and welcome. You're tuned into this special Mutual Fund Corner YouTube edition. We get you all the expert advice here. We try to break down different funds for you and tell you what would be the best time, the best category and the best way to invest in mutual funds. Joining me today is Varun Fatehpuria, who is the founder and CEO of Daulat Finvest Private Limited. Varun, always a pleasure speaking with you. Thank you so much for joining us. And you know, while we talk about long-term investing, we talk about funds that would be good for longer term and a lot more. We forget sometimes that there are shorter duration funds available as well. And one of them, of course, is money market funds. Can you give us a sense of who should be investing in money market funds? What are the different durations and who is it beneficial for?
So money market funds, Sonal, are a type of debt mutual fund which invest in security of having a maturity of up to a year. These securities typically tend to be government securities, state development loans, commercial papers, AAA corporate bonds, anything with a very minimal or a negligible credit risk. The only risk in investing in these funds is the interest rate risk, right? And this is really comparable to putting your money, let's say, in a savings bank account or in a shorter term fixed income option like an FD for 3, 6, 9 months. And where these products really shine compared to, let's say, a more traditional instrument, are the yields are significantly higher in the range of about 3 to 4%. If a fixed deposit is giving you about 4%, 4.5% for a 90-day or 180-day tenor, these products can give you up to about 7.5%. So this is something that investors need to keep in mind when investing in money market funds, that they come with a significantly higher yield for a shorter tenor product compared to a fixed deposit or a savings bank account.
Okay, all right. So just briefly, if you can tell us some of the disadvantages of investing in money market funds, and if someone is investing, what would the advantages for them be?
So the only disadvantage, to be honest, that I could think is that it is not a guaranteed return product. Let's say if you're investing in a fixed deposit or a savings bank account on day zero, you exactly know what your return would be at the end of a tenure. Since a debt mutual fund are a market-linked returns, the only way of actually gauging what your return could be by investing in this fund is to potentially look at what is called as a YTM or a yield to maturity of the fund, subject to any expense ratio. The yield to maturity will effectively tell you what your return could potentially look like if all the securities in the portfolio mature up and about their intended maturity date. So that could give you a good sense of what the returns could look like when you're investing in a debt mutual fund product like a money market fund. Again, today the returns are in the range of 7.5%, given also where we are in the interest rate cycle. The repo rate is probably at its peak. And if the interest rates start to come down from here in the next 3 to 6 months, then investors could also realize the potential capital gains on their investments. So that is one of the biggest advantages. The drawback of investing in such a fund is that in the interim, you could see some potential mark-to-market losses on your portfolio. Now, again, when you're investing in a fixed income instrument, investors typically are not really comfortable with seeing even some losses in the interim. So that could be a potential drawback of investing in these funds. But again, something to note over here is that even in a debt mutual fund, there are a whole plethora of options. Always try to time your or invest in instruments that mature in and around what your investment horizon is. So if you're investing in a money market fund, these typically tend to have a duration anywhere between 8 to 12 months. So if your intended investment horizon is somewhere between then, so you could then potentially look at this as an investment option.
Okay, all right, interesting. So how do they differ from savings bank account, and is there a bigger spread that we see here, considering that we have not seen a big hike in savings bank rate in last couple of months, despite the repo rate hikes that took place last year and before that?
So again, Sonal, as you currently pointed out, the transmission of the increase in interest rates have not really flown down to the savings bank account level. They continue to offer a meager 3.5% rate of interest. That is primarily also because it is more of a liquid vehicle where the depositors or the customers are more incentivized to keep their money and provide that float to the bank. Where the transmission of the rates have actually happened is at the fixed deposit level, where again, on the shorter end of the tenure, the rates have not really matched what the repo rate would be able to provide you. But as you go down the curve to about 9 to 12 months, at that point in time, you could see the interest rates have started to move in the range of about 6.5, and even 7%. So that is where the transmission of rates have happened. If you were to compare that to, let's say, a money market fund and look at a fixed deposit or a savings bank account, one of the areas where the latter also shines is that there is no applicability of a TDS which happens. So the money continues to compound on the return that you are able to generate in that interim period as well.
No wonder banks are worried about deposits, because people are going ahead and investing in this category or mutual funds more than banks. So that explains the difference here. Lastly, Varun, if you can, you have spoken about the rate of returns that we've been seeing here. Is this a good category to invest in now? Can we expect, how would the interest rate scenario change the way returns look like here?
So again, one of the biggest advantages today as we speak, Sonal, is that since we are at the peak of the interest rate cycle, once the interest rates really start to come down, at that point in time, you could also see the benefits of a potential capital gains coming into the picture. The reason is that once the interest rates start to come down, you see a mark-to-market increase in the value of the bonds and the securities that are held by these debt mutual funds. Obviously, the longer the duration of the fund, the higher is the impact of the interest rate cut. But these are, again, since simpler products, lower duration products intended for customers and investors having a duration of up to about a year, then instead of looking at more traditional instruments like a savings bank account or a fixed deposit, investors should instead consider looking at a money market fund, which could potentially offer a spread of even more than 2.5% than what your fixed deposit could offer you, given the interest rate cuts start to happen in the next 6 to 9 months. So this could be a potentially very interesting category for investors to consider having a shorter investment time horizon.
All right, we take that point. Varun, thank you so much for joining us with your insights today. That's all about money market funds. And of course, we'll keep getting in more opinion and expert advice as well. For now, we'll take your leave on this edition of Mutual Fund Corner. Stay tuned for more news and updates.
Bandhan Mutual Fund presents MF Corner.